Hello, with me today I have Matthew Jennings, Equity Income Investment Director at Fidelity. He's here to talk about the Fidelity Global Dividend Fund. Hi, Matthew.
Hello, good morning.
The investments landscape is very different to how it was just a few weeks ago, even 4, 5, 6 weeks. Share prices are significantly lower. Is the Global Dividend Fund portfolio been reshuffled at all because of the dividend crisis? Are you taking advantage of lower share prices? And I guess what I'm driving at is, what has the fund been buying and selling during the crash?
So we've been buying into some of the businesses that we really like for the long term, and where the share price falls feel maybe disproportionate to the actual impact on the business. I'll give you a couple of examples. Cisco is a technology hardware business based in the US. They actually have a product called WebEx, which helps people to work from home, which is obviously getting a lot more interest these days. But also a lot of the components that they supply are really critical in the communications infrastructure that has allowed the economy to continue functioning to some extent. So Cisco, and combined with that attractive long-term picture, you get a good dividend yield of around 4% on a gross basis for Cisco. We also own Roche in the portfolio. We've been increasing our position there. Roche, Swiss pharmaceutical business. This has also been in the news recently. It's one of the main suppliers of test kits for COVID. So, alongside that, it's got a very attractive long-term pipeline of new drugs and new treatments coming through. So both of those businesses have been, the share prices have fallen, but actually when we look 3 years out, we think the businesses will emerge from this stronger than ever.
Okay. Well, I mean, that's interesting. But I'm looking at the sort of the top 10 holdings for the fund. Now, there are no high-yielding miners or oil majors like Shell and BP in the top 10. I mean, I guess, or indeed the supermarkets like Sainsbury's or Tesco, which has just announced a big increase in the dividend. Why is that? And might that change given these particular sectors and stocks are among the few still returning cash to shareholders?
Okay, so obviously the oil company is very different to supermarkets, so I'll maybe deal with them separately. For oil, this is a tricky sector for investors because oil companies really rely on what happens to in oil markets, which is a highly politicized market, as we've seen recently. So it's very difficult for us as bottom-up investors to take a high conviction view on an oil company and the type of dividends that we can expect to receive from them going forwards into the future. And this is really what explains the absence of these commodity businesses from our portfolio. We really prefer businesses where their fate is in their own hands to a greater extent. Now, for the supermarkets, you're right to highlight the fact that they've, of course, been relatively strong through this recent period. But actually, remember, we're global investors. We don't only have to invest in the UK. So we've got a global investment universe, and there are many, many companies which are continuing to grow their dividends, or at least pay their dividends. And so our opportunity set is much broader than to someone who's restricted to only investing in the UK. So we're not just basing our investment decisions on, is a company going to pay its dividend this year, but we're thinking about 3-4 years from now, are we owning really the best businesses? Okay.
And around sort of Shell and those oil companies, are they given that Shell hasn't cut the dividends since the Second World War, and whether it does now or not is unclear. But they're doing everything they can, I think, to keep that record up. Is Shell? Well, what are your views on those oil majors and their dividend sort of properties?
Yeah, so Shell is actually a business that we used to own in the portfolio, because we like the management team's approach to managing the business, frankly. Much more focus on generating free cash flow and potentially an ability to grow the dividend. Now, unfortunately, the good quality characteristics that have been shown by the Shell management team in recent years have been overwhelmed to a large degree by what's happened, outside of their control in the oil markets. So you're right, of course, to say that they continue to pay their dividends for the time being, but we've got to remember that in the long term, I know we're concerned about coronavirus, at the moment, but before that, we were talking a lot about climate change. The role that oil plays in the economy is being, increasingly open to question. The demand for oil does rely to a large degree on fuel for transport. There are increasing moves to electrify cars and other transport networks. If that happens, we may go into a period where demand for oil in the very long term is a bit lower than it has been historically. So, there are, even taking the recent events out of the equation, we see a lot of uncertainty around the outlook for these companies.
Okay, and I know you did have a sort of holding in Shell at sort of at one point. Is that still the case?
No, we don't own Shell anymore in the portfolio because of that sort of point about the increased uncertainty around the defensiveness of the business and its exposure to oil prices.
Okay. Well, look, you're the professional, so you've been doing this a long time, investing in businesses and sectors and geographies. Now other investors might not, clearly haven't got your experience. So I'm just wondering whether you could sort of share any sort of strategies that DIY investors might employ in current markets, in a falling market.
Yeah, well, I certainly wouldn't claim to have all the answers to ensuring good performance in difficult market conditions like we're experiencing now. What we can do, though, is reflect on history a little bit. And typically, when markets experience big falls in share prices, it can be very tempting and maybe psychologically easier to just sort of throw up your hands and say, this investing game isn't for me, and actually I prefer to just hold cash because that's less stressful and lower risk. But in the long term, that's just not a good way of benefiting from the long-term value creation that the equity market can provide. So, again, I've mentioned this a couple of times. I think trying to think long-term is really, really important. Trying to think in a calm way, when there's so much uncertainty around you, so much stress, potentially, health concerns. It's not an easy environment to take long-term investment decisions, but let's try to do our best to think 3 or 4 years ahead from now. What type of portfolios do we want? And trying to be too clever and time the market and sell and then buy back later when things look better, this is very, very difficult to do. It's not something certainly that I'm capable of doing, and I don't think, frankly, that many people are. So I think long-term thinking is the key.
Sure. And look, according to the last set of data that the fund issued to the end of February, it says the portfolio is currently about 5% cash, the rest equities. Now, are you keeping some powder dry, or is that 5% about the normal sort of cash levels that you'd keep during more normal times?
Yeah, I was just getting a bit nostalgic for the end of February there. It seems like a long time ago, doesn't it?
Absolutely.
No, I mean, that is a fairly normal level of cash for us to hold. But I would also highlight that, since then, we have reduced the cash position a little bit in and deployed some of it into the attractive opportunities that we see in the market. I've already mentioned a few examples, but there are other examples of opportunities. So we've put some of that cash to work.
Okay, Matthew, thank you very much.
You're welcome.